Good morning and welcome to Sector Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at site, we have Masood Galsi. He's with the Nasdaq IR intelligence team. We're going to set the stage for trading this week and focus on the dichotomy between equity performance and what we're actually seeing within economic data. Masood, as always, thanks so much for joining us at MarketSite. And let's run through some of these themes that developed last week and how it's impacting the markets.
Of course, thanks for having me on your show, Jill. So 4 key data points last week. 1, manufacturing data, industrial output came in relatively weak. This does not bode well for the economy. 2, CPI and PPI data came in, so inflation is relatively tame, and this is inflation as measured by CPI and PPI. Thirdly, retail sales and also University of Michigan consumer sentiment came in slightly higher, but not very strong, not very encouraging. So I think the discussions we've been having thus far, the 3 major themes still continues to be in play, which is 1, economic data is plateauing, it's oscillating, or it's dropping slightly. That's the first theme. The second theme, to your point, again, the dichotomy between the equity markets and the debt markets. We're continuing to see the equity markets rally and also yields compressing and the debt markets rallying. So that's the second theme. And the third theme is the disconnect between economic performance data, which is relatively weak, as just explained, and also economic data, that is weak, and equity performance, which is strong. Now, to break it down and get a little bit more granular, we're seeing technology stocks, internet stocks, growth names leading the rally. We're also seeing, growth names leading the rally, excuse me. We're also seeing stocks that are leveraged to the economic cycle. So these are industrials, energy names also leading the rally. And finally, 10-year Treasury yield bonds hit a 2-month low. So we're seeing a continued compression of Treasury yields.
All right, now the Fed is really attributed to some of this rally as well, and they're meeting again this week to kind of assess where the economy is right now. So that could potentially be impactful to markets as well.
Correct. So we'll be hearing from the Fed on Wednesday. They meet on Tuesday and Wednesday. So all eyes and ears on 1, the neutral rate of interest, where that's going to be. So the dot plots. 2, their views on the economy, especially the international side of things, especially given that global central banks and the Fed have been monitoring economic activity very closely and have been pausing monetary policy, the tightening of monetary policy in places like China. They're easing monetary policy on the heels of low economic growth. So that's the Fed side of the equation. In terms of its impact on the market, again, I come from the school of thought that when the Federal Reserve tries to battle growth, they essentially create inflation. So we're seeing yield compression. Over the course of the last several months, we saw negative yielding debt climb from $6 trillion, and this is global data, to $9.5 trillion. We're seeing sectors like utilities, which are bond proxies, and also REITs continuing to rally, and utilities is a defensive bond proxy sector. And finally, it's fueling a rally in the equity markets.
All right, let's talk about U.S. economic data. What about the fears of recession? We haven't heard too much about that, but we are seeing some revisions in terms of GDP.
Yeah, so a couple points here, again, at a very high level. 1, in terms of recessionary fears, it seems to be low over the next 12 months. Analysts and research analysts are estimating anywhere between 20 to 30% chance. The data is kind of all over the map, so there seems to be no consensus. In terms of GDP numbers, we're seeing a lower Q1, and generally Q1 is a lower, registers a lower number relative to subsequent months. Q2 is being revised higher. In terms of economic policy uncertainty index, that had spiked in Q3, Q4 due to the tariffs and fears of global trade. That seems to have eased and has come down. 4, there are signs of recovery. Seeing data points that are showing that towards the second half of 2019, growth may kick back in, especially as trade tensions have eased. And finally, on matters of trade, U.S.-China, seems as though tensions have been easing. However, the summit between President Trump and Xi has been pushed back to June. I think the Chinese government wants some more certainty before they have the meeting so that Trump doesn't walk away the way he did with Kim Jong-un. And finally, with respect to tariffs vis-a-vis Europe, that seems to be waning off also.
All right, now let's wrap it up with the trading week ahead. You'd mentioned one of the things you're going to be watching is the Fed. What are some of the data points that you have on your radar this week?
Correct. So we'll hear from the Fed. 1, 2, durable goods, manufacturing PMIs, so more from the economy. And finally, across the pond, we'll hear from our friends about Brexit. Great quote comes to mind. The CEO of BP the other day mentioned that throughout his life experience, that all major deals get closed at the very last minute. So he's expecting some sort of a resolution this week or the following week.
All right, so it sounds like kind of a lot of the same as last week, since we're kind of that earnings vacuum right now, so it's really going to be macro that's on the headline for this week.
Yep.
All right, Masood, thank you as always
so
for
much.
joining us. And thank you for joining me throughout the week. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.